Yep.
What happens when outside investors get involved in lawsuits? Is it a game changer for plaintiffs who lack resources or a controversial practice with hidden risks? And how do these risks affect businesses? Welcome to Future of Risk, presented by Zurich North America. We explore the changing risk and resilience landscape and share insights on the challenges that face businesses to help you meet tomorrow prepared. Social inflation refers to the rising costs of insurance claims and litigation that go beyond general economic inflation. They're driven by societal factors rather than traditional market forces. Those factors include social attitudes, legal practices, legal system abuse, and cultural norms. In this mini-series, we explore how the impact of social inflation goes beyond the insurance industry and leads to higher insurance premiums for businesses, a strain on the economy, and growing financial impacts on everyday consumers. Today, we're continuing that exploration by looking at a topic that's shaking up the legal world: third-party litigation funding. I'm Al Orendorff, and today I'm speaking with Keith Daly, Chief Claims Officer at Zurich North America, and Sherman Joyce, President of the American Tort Reform Association. Keith and Tiger, welcome to the podcast.
Thanks for having us, Al.
Al, thank you. Great to be with you.
I said a moment ago that third-party litigation is one of the causes of this larger trend of social inflation that we're seeing. Keith, can you start us off by helping define what third-party litigation funding, often known by the acronym TPLF, is?
I'd be happy to, Al. So as you said, third-party litigation funding, it's also known as litigation finance. So it's a practice when an independent third party provides a financial resource to a plaintiff or a law firm to fund litigation for a share of really the financial recovery. So I think one important point, it's a non-recourse loan. Non-recourse funding is really around that there's some risk to the funder themselves. If there is no recovery, that funder is out of their investment. So the proponents of litigation funding are certainly there, that it balances the playing field. It allows a plaintiff to have the resources to pursue litigation. The folks on the other side of the ledger would really say what it's done is really driving up litigation costs and the duration of litigation, because more cases or funders are present where we can't reach a resolution because really the funder is looking for a bigger payday. And it's unregulated in most cases, and the funders, because again it's a non-recourse loan, the returns they're getting are usually in the 30 to 50% range. So it's not your traditional financing operation.
Tiger, from an industry perspective, what does this mean?
Yeah, I think, thank you, Alan. Thank you for letting me join you for this discussion. This is a terrifically important issue for those of us in the legal reform community. I think Keith, really hit some of the key points, sort of set the table. And I think that what's important to recognize is that there are really multiple forms of litigation funding. It could be involved in the sort of from the standpoint of whether it's insurers or plaintiffs' lawyers or defendants, some of the sort of smaller personal claims. Somebody might have a workplace injury or slip and fall in the grocery store or a minor auto accident. And, the argument is that while the process moves forward to potentially resolve a claim, people have needs. They've got to meet their rent, mortgage payments, just routine expenses. So looking for funding to sort of fill that gap, up to very sophisticated private equity and other hedge fund type entities that invest hundreds of thousands, if not millions of dollars in complex litigation. So it really sort of spans that whole arena. And it's from the standpoint, I can say this as someone who went to law school a long, long time ago, this is totally new. In our history, the legal system, civil justice system, has excluded outside interests, whether it's someone in a slip and fall case or in these private equity cases. So it's important to recognize structurally how important this is. Keith used the term, I think is exactly on point. It's, non-recourse. So these entities or these financial institutions participate really without the sort of guardrails that normally you see with consumers, particularly in these sort of consumer type matters. So it's a fundamental change to civil litigation. And I think to suggest otherwise, which certainly the funders do, and even some, and it's not necessarily unanimous within the plaintiffs' bar, but there is a recognition that this really changes the nature and scope of litigation and a lot of the how matters arise and certainly how they're resolved.
I think that's an important point that you made about the fundamental aspects of this issue, and I want to dive into that in a minute. But first, and you touched on it a little bit, Tiger, are there characteristics of a legal case that tend to attract these TPLF funders, and if so, why?
Well, I'd probably give you maybe a little bit more than you're bargaining for here, but I testified for a legislative committee in Kentucky, I think in 2023, more about the sort of the consumer side. And as Keith mentioned, these entities are looking for a return in the 40 to 50% range. So if you borrow $10,000 from them, that's going to accumulate at 40 to 50%. That's a pretty healthy rate of return. The common element of those cases, and I would suggest even the private equity funded matters, is they do a lot of research and they think they're going to win. This is not a case of, investing in coin flips where it's maybe it's going to turn out well or not. They're expecting success, and they would admit that their success rate is quite high. So I think that's an important factor to contemplate.
I think that it attracts all kinds of cases, whether it's some of the smaller claims, slip and fall, auto accident type matters involving someone trying to make up for short-term economic needs. But one of the areas that we've really seen this is in what we call the mass torts area. And that is where major financial institutions, hedge funds, private equity firms are really investing in actual litigation. And, if you watch on television, you see ads for pharmaceutical products, asbestos, Roundup, et cetera. A lot of those ads are really underwritten by the prevalence of these litigation funders. And so it really helps to establish this really pernicious issue of these mass tort abusive cases that we see. So it's really, probably in terms of prevalence, those are the major focus, but it impacts cases from those very large claims with hundreds, if not thousands of claimants bringing similar cases down to the individual auto accident or slip and fall type case.
Yeah, and I'd add, jumping in there, is really, I think as you can see, it's no case is sort of immune to having some attractiveness for a funder. I think the challenge for our industry and for businesses and consumers is really the not being aware of it. So there is a complete unknown component to when a funder is involved in a case because it's not known to the defendant. There are very few disclosure laws that exist across the U.S. where someone has to say, hey, we have entered into this lawsuit. Typically, a lawsuit is on its most basic level, an injured or damaged party filing suit against the tortfeasor or the person who is purported to have caused the damage. And so you sort of have a one versus one or a corporation versus an individual. With the advent of a funder, you're adding a third party who now has an interest in that plaintiff's case. And so our argument really is, because I think the existence of funding it was mentioned, it's new to the litigation environment, but it's so prevalent and it's probably not going away. What we are advocating for is disclosure, because you take it to its, furthest degree, the judge who is presiding over a case doesn't know who the parties are. And if there's conflict of interests that could be there that aren't disclosed, they aren't disclosed. So they're unknown. So it creates a level of uncertainty. So we just want to know who are all the parties to a case, who is an interest in the case, so that the lawyers and the judges can all know that there's a conflict of interest that might exist that might not be known. So it's a big part of our advocacy is to, at a state level, advocate for disclosure laws in every environment in the U.S.
I think you hit the nail on the head. And I try to put myself in the shoes of a judge. And a judge wants to make sure, a judge functioning as he or she should, to ensure that whatever happens in a courtroom serves the interests of the parties, and to make sure that he or she understands where the incentives are. And if there is this uncertainty, it really almost raises the question of, whose interests really are being served. And that goes back to why this is still new. It's because it does interject, as we both discussed, this alternate priority, or this other entity that factors into the process.
Yeah, and speaking of awareness, and I hear you, Keith, when you're talking about disclosure. I don't know what the rules are. Do we know, can we know who these TPLF funders are?
Well, the answer today is no. Can we? Of course. But the reality is, if there are no, mandates or regulations around it, they don't have to disclose it. And so it is completely blind to, again, the judges, the lawyers, the defendant, the insurance carriers, that they exist. And so that's the challenge, because you just don't know who is in the room and really who is the decision maker. Before you even get to a courtroom, a lawsuit has a life cycle, and there are typically settlement opportunities, mediations, things like that occur that try to keep things out of a courtroom. In some cases, with the rise of litigation funding, it certainly appears to have changed some of that time and duration, where maybe a value that historically would have been perceived as acceptable to both sides is now being rejected, and the message clearly being, we want our day in court. We want to swing for the fences to see if we can get that nuclear verdict that is often talked about. Because if I'm making the investment, to try this case for a big return. I'm not trying it for just to compromise a settlement at some point. And so it's a uniqueness that has certainly entered the conversation over the last several years, which gets to what, there's got to be a reason for it. And the reason, we believe, is the litigation funders that are out there. And we're just looking to know who they are, what their interest is, and disclose it to all parties so that we're all transparently dealing with the issues that we're trying to resolve.
It sounds like these funders have no real direct connection with the case. So what is their incentive to fund litigation in these instances? Tiger, can you take that one?
I think that this is sort of the age-old quest for return on investment. I think the investors are finding it to be, a great return. But even this raises the question of, we don't know, because I think, with maybe one exception that I'm aware of, Burford Capital, these are private businesses, and they're not necessarily going to disclose all of their details. There may be some information out there. What's the old saying? Why do you rob a bank? You rob a bank because that's where the money is. Well, the return on investment, obviously appears to be there. And I would add that, at least in the so-called mass torts world, these major multi-district lawsuits or class actions, it helps to accumulate more and more claimants. And the more and more claimants there are against, whether it's a pharmaceutical product, the so-called Roundup, and some of these other, very prominently advertised cases, that helps to drive up potential settlement values. And, I think we could talk for, the duration here about the problems with those mass tort cases, in that, but to sort of sum it up, oftentimes it's less the underlying claims or nature of the claims or the validity of the claims. It's just the sheer volume helps to drive the cost of resolving these matters. And so it just sort of perpetuates that issue. We put out a report we call the Trial Lawyer Playbook, which is utilizing the marketing strategy of advertising, where I think the data that we have, well over $2 billion in 2023, the last full year that we have access to, was spent on advertising. You have the prevalence now of the litigation funding, and then the sort of the legal centerpiece is the abuse of expert evidence in these cases. really drives these mass tort matters in these cases that attract a lot of attention.
Yeah, and I'd add to Tiger's point. I mean, I think that when you get the sophistication of a private equity or a hedge fund, they're bringing technology and quant mathematics into the discussion, and really providing the plaintiff bar an additional resource to build these cases. I mean, to Tiger's earlier point, they pick cases that they think they're going to win. And then they're using all of that technology, AI, et cetera, to find the appropriate class. And it bleeds into his last point around advertising. The spend is deafening, the amount of money that has been pumped into the market to advertise plaintiff services, try to find plaintiffs to add on to a product liability case, et cetera, like Tiger was mentioning. So the sophistication is, again, driving up ultimate cost to the defendants, which really gets passed through to consumers. Because in any litigation, if a company has to, fund damages, it ultimately gets added into costs of goods and services, which we as consumers that buy products from these big corporations ultimately fund. It's quite the vicious circle of costs of goods, because there's a litigation tax associated here in the U.S.
So we're talking about a scenario that has wide-ranging implications in the marketplace. So I guess the logical follow-up question is, how does it end up affecting businesses and everyday consumers? How does that work?
Well, I'll take a start at it, and Tiger can jump in. I think it gets to that ultimately, any of these dollars, a corporation is obviously running for profit. And so wherever their costs lie, it's part of how they price their goods and services. It's simple, same as, a consumer with your insurance costs. If insurance companies pay more damages out, the price of insurance will go up. It just raises the bar really for everything that we interact with as consumers. And so it is somewhat of an endless cycle, because there is so much cases that are flooding the court systems. It's driving up litigation activity over the years that Tiger mentioned, where there's more funding. We're seeing more lawsuits, and those lawsuits are ending in higher indemnity outcomes for our consumers or our customers.
Yeah, I would add that from our standpoint, from the American Tort Reform Association standpoint, this gets us further and further away from really resolving claims and matters being addressed and handled on the merits. One of the examples that we would highlight was from several years ago. It was a multi-district lawsuit involving a blood thinning medication called Xarelto, very popular. I actually spoke to a good friend of mine who's a cardiologist who said, it's the medication he prescribes regularly for a lot of patients, and it thins the blood. Well, there was a multi-district lawsuit involving the case, and to sort of net it out, there were thousands of claimants, and in handling this, there were, I believe the total was 8 bellwether sort of chosen by both the plaintiff and defense side. Lawsuits were actually litigated to verdict, and the defendants won all of them. They won all 8. I believe it was 8.
Wow.
It might have been as much as 10. But the net result was the case settled, but it settled for just under $800 million. So you have to ask yourself the question, when you are winning the cases on the merits, you have to settle still for nearly $800 million. That just shows the value of generating the volume of claims, regardless of the merits. Just imagine what the settlement would be if instead of being 0 for 8, the plaintiffs were 2 for 8. Then it would have probably been $2 billion. I'm just picking that number out of the air. But back to what Keith was saying, where does that come from? That ultimately, at the end of the day, comes from the consumer. There's not some hypothetical pot of money that is utilized to handle these matters. It comes from the capital of these businesses, and they have to achieve a rate of return. When they have costs, they're going to pass them ultimately on. But getting back to where we can focus on priority claims and ensuring that there are proper incentives here, I think would go a long way. But it begins with, as Keith has highlighted, the need to focus on who is actually at the table and who's making the decisions. And that's where the TPLF really comes into play.
Yeah, and I think, Al, one we haven't really talked about, who the funders are, because again, there's a couple of known funders that are public about that they offer these services, but most of them are, unknown to us. It goes beyond private equity and hedge funds, but it also could include foreign investors. It could include foreign nation states, where you really think about, the U.S. stock market and a corporation. So somebody could buy into litigation against a corporation, to use Tiger's example, bring a bunch of lawsuits, get them into trial, drive up, litigation costs, those become very public. And so you can kind of jump to a nefarious kind of point of view where, I'm trying to affect a stock price of a corporation by targeting them with litigation, making sure that these cases don't settle, that they drag out. And then you have a manipulation of our stock market where you could have investors making, shorts or longs, depending on, what your side of the aisle is. But again, it gets at who really is the party to these lawsuits and what are all of the interests. And it gets to those conflicts that we talked about earlier on. And it really gets back to the point of, I don't believe, and I don't think the industry believes, that we are going to stop litigation funding, because in a lot of cases you can buy into the, in some cases that it's appropriate and it's allowing somebody access to justice against maybe a larger defendant. But the element of, not knowing about who's in the room, we are just seeking disclosure. And so we are, along with Tiger's organization and most of the industry, we are advocating at every state level to implement some level of disclosure laws. And that's really all we're seeking, so that everybody knows who is involved in these matters so that we can, find a resolution the best way that we can.
For the last several minutes, Keith, you and Tiger have been talking about the complexity of this problem and its wide-ranging implications, which speaks to the importance, seems to me, of a collaborative approach to helping to solve it. And I know that Zurich and the American Tort Reform Association are important players in a multi-industry coalition that's actively involved in efforts to create a more fair and balanced legal system. And you talked about that a little bit, Keith. Tell us a little bit about some of the legislation and other efforts that are currently afoot to address this issue.
Well, this is really up Tiger's alley with ATRA, but from a coalition perspective, we, along with several of our peer organizations, government relations organizations across the insurance industry, and large consumers, and a lot of the trade organizations, we've tried to come together to really just focus on where our efforts would be. And so this third-party litigation funding is one of our larger things that we are working on, trying to push for disclosure laws, because like I mentioned, you have to do it in every single state. But that isn't only where we're focused. There are certain issues in different markets that we're tackling. There's a premise liability issue in Georgia that has caused outsized outcomes and responsibilities to property owners on certain litigation aspects around, liabilities that occur on a property. That's a specific topic that we are working as an industry to try to impact some change in the state of Georgia. We've had some wins in Louisiana. We've had some wins in Florida as an industry on trying to change the tort environment to either, limit time periods or bring cases to resolution quicker. And so it's certainly working with the entire industry. And Tiger and ATRA are a huge component of that. And you can probably cover an entire other podcast of things that we are doing as an industry to try to balance the legal playing field.
Yeah, just to build on what Keith said, I think the challenge here is that you have the dual system. You have the federal courts and you've got, the state courts. And as Keith mentioned, for the state courts, which is really, I think, quite frankly, where the heavy lifting, that has to be done either through the legislative package or perhaps through some rulemaking through the state judiciary or some combination of that. But it's a major focus. I make two additional points. Number one is I think that to meet these challenges, it needs broad-based business community support. Obviously, insurers have of all different dimensions have a profound obvious interest in the issue. But so do the medical device, pharmaceutical companies, energy companies, small businesses. Their perspective might be a little bit different, but all who favor a balanced civil justice system and working to achieve that will have an interest in addressing TPLF and ensuring at a minimum that there is transparency and disclosure of the nature of who's sitting at the table. This is challenging, and it's going to require a broad-based and diverse coalition of interest to support this. And I'm optimistic that it will start to get traction. And then our experience on matters like this is, once that begins, it can sort of generate momentum on itself. And I think also an important point too is the judiciary is going to take notice of this as well. Certainly the federal judges recognize that the prevalence of these multi-district lawsuits that are now, I think I've heard figures of well over 80% of their dockets are taken up by these matters. And so from their standpoint, their ability to handle the litigation that is before them is being significantly challenged. And I think there's beginning to be greater recognition of the factors and forces that are leading to that and will serve as an important incentive.
So as we wrap, what can businesses do to get involved?
They can certainly join our coalition. To Tiger's point, an insurer by nature isn't going to move the needle with a lot of legislators or consumers. I kind of view us as, hey, you took a premium and you took a risk. It's sort of the nature of the business you're in. But as we know, so many of our customers have such a share of their litigation exposure because they have either high deductibles or programs that are, almost self-funded. And so businesses are incredibly important, as well as they, employ so many constituents in a local environment where politicians and regulators need to hear from those local voters on this is important to us, and this will help us help our company thrive, that'll hire more jobs, et cetera. By joining our coalition, and you can send us an email at lsacoalition@zurichna.com, and we can get back in touch with you to when we have events, what we are talking about, how to participate in some of these online sessions, so that you can hear the challenges at a state level that might be more specific to your industry geography that you're in.
I think I would echo what Keith said, and particularly he made the comment about elected officials, public officials need to hear about this issue. One of the areas that we at ATRA particularly focus on is making the broader public case. Why is this a problem in terms of just the day-to-day costs? What are the impacts of lawsuit abuse on the average person? But I think that ultimately has to get translated into clear messages that get to public officials that this is important. I a long time ago worked as counsel to a committee in the U.S. Senate, and one of the things I learned very early on about the trial bar is that they're very focused. They are opposed to reform efforts and are always looking for opportunities to expand their businesses. They don't have 20 issues on their agenda. So that amplifies their effectiveness. There needs to be a counter push to that to indicate that this is important. Legislators, governors, and others need to hear from business leaders that this is important and particular reforms, and be unified in the push. The other piece to this is don't let the trial bar sort of split a coalition of business interests and sort of make a deal with Group A, to the detriment of Group B within the business community. So having unity and having that focus is really important. I think Keith made that point, and it can't just be the insurance industry, but obviously the insurance industry has got to be a key supporter and advocate. And that's, if you look at who ATRA is, we range from the American Medical Association, National Federation of Independent Business, to major insurer groups, the APCIA, and a company like Zurich. And so these are just, people serve on the ATRA board of directors. It's a very broad coalition of business and organizational interests that support legal reform, and that's a powerful message in and of itself.
Tiger, Keith, Thank you for shedding light on this very important topic. And thank you for listening. If you like the show, leave a comment or review wherever you get your favorite podcast. Or you can drop us a note at media@zurichna.com. Stay tuned for our next episode in our social inflation miniseries, where we'll discuss that explosive term, nuclear verdicts, with Lisa Bellino, Vice President Claims, Judicial and Legislative Affairs at Zurich North America, and Rochelle Mortimer, Senior Director of Legislative Affairs at the U.S. Chamber of Commerce. This has been Future of Risk, presented by Zurich North America.
Future of Risk, presented by Zurich North America. If you like the show, we'd appreciate it if you left a comment or review wherever you get your favorite podcasts. Let us know what you think at media@zurichna.com. And join us next week.
The information in this audio recording was compiled from sources believed to be reliable for general information purposes and is intended for Zurich clients and business partners. The information contained here may be useful to you or your enterprise when developing your own policies and procedures. The policies and procedures applicable to your enterprise should take into account the specific circumstances of your business and business environment, which is beyond the capacity of this podcast. Any and all information provided is not intended to constitute advice of any nature and is specifically not legal advice, and accordingly, you should consult with your own legal counsel. We do not guarantee the accuracy of this information presented or any results, and further assume no liability in connection with this recording and the information provided therein. Moreover, Zurich reminds you that the information provided cannot be assumed to contain every acceptable safety and compliance procedure, or that additional procedures might not be appropriate under the circumstances. The subject matter of this recording is not tied to any specific insurance product, nor will adopting these policies and procedures ensure coverage under any insurance policy. We encourage listeners to seek additional information from credible sources. Thank you.